Given that the cost of college seems to be increasing every time you turn around, and paying for your children's higher education is one of the largest expenses you'll ever have, how can you be smart about paying for it? Today, my colleague Christian DiRusso and I will be outlining two savvy educational funding strategies, Roth IRAs and hiring your children in your practice. Also, be sure to watch till the end of this video, as we'll be going over a bonus funding strategy that gets grandparents into the educational funding game, the little known HEET Trust. Hi everybody, and welcome to Wealth Matters for Physicians by Altfest Personal Wealth Management, the channel that provides key investing and personal financial planning insights to help physicians achieve their key life goals. Before I bring in Christian, a few words about Altfest. For nearly 40 years, Altfest Personal Wealth Management has been helping physicians holistically optimize all areas of their personal financial lives in a fully objective, no commissions manner, while as a legal fiduciary, always putting our physicians' best interests first. As physicians, you'll probably also want to know that Altfest is the preferred wealth manager for members of the Medical Society of the State of New York, and the preferred wealth management education provider for both the New York chapter of the American College of Surgeons and the New York State Society of Orthopedic Surgeons, just to name a few of our associations with whom we partner. As I mentioned, we are very happy to have on the channel today Christian DiRusso. Christian is a certified financial planner, a CPA, and a financial planning specialist at Altfest Personal Wealth Management, where he helps clients optimize all areas of their personal financial planning and investment lives. Well, Christian, thank you very much for being with us today on Wealth Matters for Physicians.
Thanks for having me.
Excellent. Well, let's get right into it. So, regarding college educational funding strategies, you said that Roth IRAs can be a very good tool for college funding. Why is that? First, let's very briefly, what's a Roth IRA? And then why could a Roth IRA could be a good tool for college funding? We usually think about that for retirement planning.
Yep. So a Roth IRA is an individual retirement account in which you contribute after-tax dollars. So the benefits are these dollars grow tax-deferred, tax-free, and when you withdraw them after age 59 and a half, you no longer have to pay any income taxes on them. So the reason this can be great for college planning is, A, many of you already have Roth IRAs, so that could be a good source of funding or additional funding to bridge the gap. And there is actually an exception where you can withdraw assets from a Roth IRA before age 59 and a half for the use of educational funding for your kids.
Great. So if you need some extra educational funds, the Roth IRA can be tapped. And if you don't, you can just use it as a great thing for yourself or your heirs in the future.
Exactly. You're likely contributing there ready for retirement. So if you don't have to use it for your kids and that's where you decide to save some additional money, then hey, better for you, more increased funds in your retirement.
Excellent. So moving to the next strategy, practice owners can do some special things to help fund their children's college education. What special things can they do?
Yep, so one strategy that we've been seeing a lot of practice owners use is hiring their children to work in their practice. And this can be a relatively simple job like filing papers or seating patients. But you as the practice owner will be paying your child and they will use those funds essentially to pay for their college education down the line. And the added benefit is you get a deduction and are able to write off the wages that you pay your child. So once the funds enter your child's checking account, you can help them invest it, whether that be in a Roth IRA, a 529, or even a brokerage account. As long as the child is, their wage is less than the current standard deduction, they won't have to pay any taxes on it. And if you do decide to invest in a 529 plan, for instance, the child will get some additional tax savings. For example, if they invest at $5,000, they'd be able to deduct that full amount from their state income taxes as well.
Sounds great. Sounds like a really great strategy. So lastly for today, Christian, I know that you wanted to bring up the concept of a HEET Trust. Now, HEET not meaning like it's really hot, it's HEET Trust. What is a HEET Trust? Can you explain it to us? How does it work?
Sure. So HEET Trust stands for Health and Education Exclusionary Trust. And it works similar to a typical dynasty trust in which someone, generally 2 generations above the intended beneficiary, can put money into this trust for education and medical purposes for the beneficiary. And the real purpose of it is to try to avoid the generation skipping transfer tax, which could be as high as 40%.
Okay, so basically you're saying this can help you avoid that GST tax, which can be substantial. So it would be a great way for grandparents to give to their grandchildren.
Exactly. A grandparent to their grandchildren, avoid those extra taxes and ensure that their medical and education needs are taken care of.
So Christian, which educational expenses would qualify to avoid the generation skipping tax in the HEET Trust and which would not?
So the HEET Trust actually only covers tuition. And it is important to note that the tuition must be paid directly to the educational institution, so whichever college or university your grandchild would be attending, in order to avoid the generation skipping transfer tax. The non-qualified expenses really are pretty much everything else. So room and board, any books, potentially some fees, those you would incur the generation skipping transfer tax for.
Thank you. And how does it work for medical expenses?
For medical, as long as you're paying it directly to a qualified medical provider, and it also actually includes any medical or long-term care insurance premiums as well. So things like over-the-counter medicine or even cosmetic surgery, those would not count and would be subject to the generation skipping transfer tax.
Okay, so it seems like this HEET Trust could be very good in terms of avoiding GST for qualified higher educational expenses, paying directly to the institution. Maybe also medical, but the real thing that we want to focus on today is the education.
Yep, exactly.
Excellent. Well, again, Christian, thank you so much for being on the show today. Wealth Matters for Physicians. We greatly appreciate it, and I think you've given some really good food for thought for our physician audience.
Yeah, pleasure to be here.
If you'd like to discuss the information explained in today's video, receive a complimentary analysis of your investment portfolio or retirement readiness, or discuss any of your other personal financial planning areas with an Altfest professional at no obligation, please contact my colleague Jesse Freeling at 212-796-8732 or by emailing Jesse at his email address, which is also in the description of today's video below. If you like today's video about providing insights to help physicians optimize their personal finances and achieve financial independence, please click the subscribe button and hit the bell icon below to receive notifications each time we receive a new video. If you think that a fellow physician would find this video interesting or useful, please share it with him or her to help them also get their finances optimized. Lastly, as always, this channel is for you, and we want to make it as useful and as enjoyable as possible. If you have topics you'd like us to cover, like or dislike certain things that we're doing, or have any other feedback, we'd love to hear from you, so please share your comments in the comments section below. Well, that's all for today, physicians. Thank you very much for watching today's video, and I look forward to being with you in our next one. Until then, be well, and remember to keep on optimizing your finances, or let us help you if you'd like.